Hello and welcome to the Option Workbench Discovery video. Today is Tuesday, August 19th, 2014. And what I'm going to do right now, it's about almost 11 o'clock in the morning. I'm going to go through uh, what I did this morning to find an opportunity and enter a trade that I did this morning on Tesla. So what I did was I came in and I took a look at the IV percentile histogram. You can see that the mean is down here, way down here at the 13th percentile. So options are pretty cheap compared to where they've been in the past, over the past couple of years anyway. Over the even a week or so ago, the mean was up here around the 40th percentile when we had that little correction. The VIX term structure, spot VIX is way down here, and you've got a around 12, a little over almost 1230 and change. This is actually as of yesterday's close. And then the term structure is pointing upward, which is kind of bullish for stocks. So what I'd like to do actually is start with looking at naked puts. One of my favorite strategies, my bread and butter strategies, is selling premium for income, and I usually start with naked puts to do that. I don't always sell puts, and I'll go through the analysis that I did and arrive at the trade that I actually ended up putting on and getting filled. So I'll go over to spread profiles and click naked puts. And you can see that as of at the close or last night on the strategy zone, there were 13,576 naked puts analyzed, which are potential trades that we could do. And despite the volatility being as low as it is, with the VIX down quite a bit even more this morning. So what I'm going to do is go through my filter formula that I've been using for several months now, and I found a bunch of trades like this. I'm actually doing pretty well with it. What we want to do is filter these all these rows down to a manageable number. 13,000, over 13,000 is just too many to deal with for one person. So what I want to do is open my filter formula editor, and what comes up is this little editor dialog. On the left hand side here, I have all my naked put filters. I've selected my DBE sigmas for equities filter, and DBE stands for downside break even. The DBE sigmas is one of the columns in the naked put table. If I click on the help, it shows me a list of the columns down here. These are some of the functions that I can use in the formula. I've got some filter formula workshops that I did a while back that are on the website too. You should be able to see them where you're looking at this video. And then I can see down here, here's the DBE sigmas. This is the sort of the main column that I'm using for the filter, and it's the number of standard deviations that the downside break even is below the stock price. And we've got the little formula there for figuring out what that number is. So when I'm selling premium, I don't want to be assigned. There's another strategy that you can use if you actually want to own the stock, where you can sell puts at a price that you don't mind owning the stock, and then if you get assigned, then okay, you own the stock at the price that you wanted. But if you don't, you get to just keep the premium and move on, and maybe get assigned later on, and in the meantime make some money. I'm not in that camp of put selling right now. I'm just selling premium to make some income. So I want the downside break even to be far enough away from the underlying price that I have a reasonable probability of not being assigned, and that I can make some money on. So let me close that help screen, and I'll go through my little filter here line by line. Now this one is for equities. I have another one for ETFs. So that one's a little bit different. On the first line here, so I'm putting together the first line is the and. So I'm putting together all these criteria, or criterion, and I want them all to be met in order for a naked put to meet my to be able to be considered for a trade. So the first thing is I want the expiration date to be prior to the next earnings date. That's kind of an important feature of this little filter. I don't want to sell a put ahead of an earnings announcement, even though you probably get a good premium for that. If there's some kind of surprise and the stock goes down, you stand the risk of the stock going way down below your strike price, and then you can be in trouble owning the stock where you really don't want to own it. So the next two lines here are I don't want to consider ETFs for this filter. So I have two watch lists. These are public watch lists, one called equity ETFs and the other called commodity ETFs. That contain names of ETFs in those categories, equities and commodities, and I want to exclude those. So I use the enlist function and I wrap them in a knot. So that means a naked put will match if it's not in the list called equity ETFs and it's not in the list called commodity ETFs. So that way I'll only have stocks in my list. Here's the DBE sigmas. Now, since the volatility, the implied volatility, as we saw from the histogram, is kind of low, I've had to lower this number down to 1. So I want the downside break even to be at least one standard deviation below the underlying price. In the past, I've had this as high as 1.3, 1.35 when volatility is higher. But right now, with the current market conditions, I need to be satisfied with just one standard deviation below. That also highlights that these filters are not kind of concrete or set in stone. They kind of evolve over time, and they're still the same filter. So the next thing that I want is I want to sell the premium for a short period of time. So I want the number of days to expiration, that's the days column, to be greater than 5, but less than or equal to 45. This is another piece that I change a lot depending where we are in the expiration cycle and the earnings cycle. I'll sometimes have that as low as 25 days or 30 days, but right now I have it set at 45. I want the put price to be at least 50 cents. I want to get some meat on the bone for what I'm selling here. I want the annualized expected return to be at least 10%. And expected return also plays a big part in this trading strategy because once I put the position on, I keep an eye on, as time goes on, what that expected return is, and I want to keep it on as long as I have a positive expectation. Since I put it on with a positive expectation, I want to keep it on while I have a positive expectation. And if the expectation starts getting negative, which you can see in the P&L monitor, that won't be part of this video, but you can see that in the position management video. If that expectation starts getting negative, then I start thinking about getting out of the position. It also depends on how close I am to expiration and what the probability is of being profitable at that point. So sometimes I'll get out when I hit negative expectations. Sometimes I'll hang around for a couple of days if the probabilities are still decent. But a lot of times I'll just bail and move on, because whatever name it is will come up again and I'll be able to make back the money sometime in the future. The next filter is the IV factor. Let me go back to the help screen. The IV factor is here. Basically that tells you a percentage premium or discount that the implied volatility of this put that you're looking at is relative to the composite implied volatility of the options, all the options in that class. So a large positive numbers represent expensive options, and negative numbers represent cheap options. So for this filter, I want that number to be greater than 0 because I want to sell expensive options. I don't want to sell a cheap option. Again, this is another number, and along with the annualized expected return that I play around with. And when the histogram shows me that options are more expensive, I'll want to sell more expensive options, and I'll have sometimes that number will go up to 10 or 15, and the annualized expected return can go up to 25 to 30%, depending on market conditions. So right now with the relatively cheap options, I have these at kind of at system lows, as you might want to put it. And then finally, the final criteria is I want the total option volume. This is not the volume of the underlying equity, but the total option volume for the prior day to be at least or greater than 2,500 contracts. This is because I want some liquidity. I don't want to get into sell a put and then be have all the open interest and not be able to get out if I have to, if the expectation goes negative and my probabilities go negative. And then finally, for this filter, I have some sort criteria. I am sorting primarily by the IV factor because I want to sell the most expensive options I can. I'm sorting by that in descending order, and then within if two or more options have the same IV factor, I want them sorted in descending order by the annualized expected return. So I want to sell the most expensive options with the highest expectation possible. If you want to know, while we're on the subject of expected return, if you want to know more about how to use expected value and expected return in option trading, you can see the video on the website or download the white paper on using expected value. It's become pretty popular recently. Okay, so that's my filter that I'm using for today. I'll click the apply button, and then within less than a second, I've gone from 13,576 potential puts down to 32, which is a much more manageable number. And again, I've been using this particular DBE Sigma's centered filter since about November 2013, and it's been working pretty well for me. So now I'm going to go down the list, and I'm going to pick Tesla. I went through a bunch of these before, and just I didn't choose AFCI. That's a financial services company. The premium on this is, as I think, too good to be true. I think there's something going on here. 55-cent premium for a $45 stock is pretty high. So I think there's something else going on there. The other one here, VRX, it's Variant Pharmaceuticals. They're involved in some kind of takeover rumors, so I don't really want to get involved with that one. Moving down the line here to Herbalife, I already have a position open in Herbalife, so I'm not going to look at that one right now. When that one expires, hopefully Herbalife will still be on here. So I went through LinkedIn and Win and Netflix, but what I want to look at right now is this Tesla 237.5 put. So I clicked on the link for the put, and it brings me right here into the position analysis window, which shows me the profit curve for the trade in this window down here in the delta risk window. The red line here is the expected profit, and you can see that's actually below the zero line here. I'll get back to that more in a second. So in the table up here, we see the trade that we're looking at. So right now, this is a $1.15 credit. It wasn't that high on the option profile. I'm sorry, on the spread profile. But now I'm getting live prices. This is the actual bid price, $1.15 for this. It's a little bit higher, so and that's because Tesla is actually down today. It's down 540 now. I have real-time prices coming in, so that 237 and a half put is commanding a little bit more premium. And since it's down, I don't really want to deal with that put. So what I'll do is I'll start looking at the 232 and a half because the stock is down $5. I'll go down $5 on my strike. So I'll click the X here to get rid of that one. Go to the sell menu, pick single put. August 29th was the expiration, and then I'll go down to the 232 and a half. And so the bid for that is 71 cents. I'm going to go at market. I'm sorry, at mid. I can get 75 cents at mid, and I'll add this position to my analysis, and I can see that I still get a slightly negative expectation, and I still have the 75-cent credit at mid. My default lot size is 10 lots. That can be changed in the settings. So now it's 75.5 cents. So I'm getting $755 credit. The implied volatility of the option is 39.4.5. The IV factor, this tells me it's 15, so it tells me I'm selling expensive volatility, which is what I wanted to do. Expected profit right now is negative, but we'll see a little bit more about that in a minute. Expected risk, this is a margin calculation. Probably my broker will want to hold $43,000 in margin for this naked put, which is kind of a lot. Obviously I can reduce the size and lower that margin, but that's going to lower the amount of money that I pull in. But we'll see how we can hedge that, make that expected risk a little bit smaller without sacrificing any of the cost. Next column is the expected return, which is expected profit divided by expected risk. Then we have the annualized expected return, which is a compound annualization of the expected return. It uses a compound annualization because you can take the money that you earn from the put, from selling the put, and reinvest it in the market, and you'll get compound returns. And then finally, we've got the Greeks of the position. Okay, so the first question is why is the expectation negative when back on our naked put profile we specify that we wanted a positive expectation. Now the numbers on the strategy zone, that expected profit or expected return, is generated using the implied volatility, using the composite implied volatility from the day before, which we can see here is 34.5% or 34.4%. Tesla's going down a little bit more now, so that's quite a bit lower than what Option Workbench picked, which is going to be the 100-day historical volatility of 45%. And the reason it picks that is because it tries to be conservative in its estimates of when it first does risk analysis. So since a short put, this position has a negative gamma, which means that it benefits from a low realized volatility environment, meaning that we don't want the price of the underlying to change that much. The Option Workbench picked the highest of the 20, 50, and 100-day historical volatilities, and that's just to be conservative. Now we can go in and change our volatility assumption, and we'll do that in a minute, but we really need to figure out there's a lot of different volatility assumptions that we can make for calculating the expected profit. Uh, one is obviously we can use one of these historical volatility numbers. I mean, you could go as low as 30% and say, well, over the last 20 days, the stock has only moved at a 30% annualized volatility, so I'll use that one, even though it's down probably a little bit more than that today. Um, you might still want to use that because this option expires in less than 20 days, so you might want to use the shorter term volatility. You could use reasonably, you could use the implied volatility of the option. You could use the composite implied volatility of 34.4. Another way that I like to validate that composite implied volatility, or even the EIV of the option itself, is to look at the at the money straddle. So what I'll do is I'll click on the buy straddle menu here, and here's my straddle I'll use next week. That's the one we're interested in. 252.5, that's the closest to the money right now. I'll click add there, and we can see that straddle IV is about 35%, which is pretty close to the composite IV and the 50-day historical volatility. So we'll just keep that one in mind, and let's close that. One other volatility that I like to look at is the one generated from the fat tail distribution, or the empirical probability distribution. So I clicked on the probability analysis, and what I see here is a probability density using a year's worth of closing prices for Tesla, and we can see that resulted in a 62.8% or 62.9% annualized volatility for days over the last year. Now that also includes earnings dates, so I can actually exclude earnings from that, and that lowers it down to 56.9%, call it. And what I want to do is go back 3 years. So that gives me a pretty big sampling of data, and I can see that the annualized volatility over the last 3 years, using actual daily price changes, excluding earnings announcements, because earnings announcements tend to be big moves on the day after an earnings, and since I'm selling this volatility and whatever I sell is going to expire prior to the next earnings announcement, I'm going to exclude those from my probability analysis and my volatility assumptions. So here's a number of call it 55. Now we can go back to strategy analysis, and 55 is quite a bit higher than the numbers that we were dealing with more recently, and that's kind of in line with that the histogram is showing that the volatilities are very low. So what I'm going to do is I'm going to pick the 36% volatility, because that's in line with the composite IV and the at the money straddle for the same expiration. So now, to change that volatility that's used to calculate the expected return, I'll click on my volatility shifts window. Here's the 45 that Option Workbench picked because our naked put has negative gamma. And then I'll go in there and change that to 36. And I'm also going to change to the fat tail distribution. Initially, it picked the log normal distribution to use, but since we estimated our volatility, we looked at the probability density for the fat tail for 3 years excluding earnings. That's what I'm going to use for the expected value calculation, expected return calculation. So I apply those, and now I've got a nice 26% annualized expected return on this naked put. Okay, so now how do we address the risk of this? One thing I don't like about naked puts, and a lot of people don't like, is that they have this really, you know, danger of big losses if the stock makes a really big move. Now, the first thing we've already done to mitigate that is pick a strike that's pretty far out of the money. You can see here's our one standard deviation down from the current price of 253.82. If I move down to the break even, which is down here at 230, what do we got here? 231.70 approximately. I can see that that is 1.43 standard deviations away from the current price. So that gives me a lot of downside protection right there. But I still don't like the fact that I have this break even that's so close, and to my the strike that I'm selling, as well as this, in case there's a black swan, complete market meltdown, I got a lot of risk on the downside here. So one thing that a lot of people do is sell a put vertical. That's a very popular position to take for this premium income strategy. Two reasons that's popular is that A, it'll reduce the risk. You've got a fixed limit on the downside of what you can use, and it also lowers the margin because the margin is fixed at what the width of the spread is less the credit that you get. So now let's compare this to a put vertical where we're going to sell the August 29th 232.5, and let's say we're going to buy the 222.5. So there's the 232.5 and 222.5 for the same 10 lots. I get a mid price right now of 45.5. We'll leave that as is for the time being, and I'm going to add that spread, that position, to my analysis. Now again, we can see that it's got a negative expectation, and again that's because the position has negative gamma. So Option Workbench chose the 45% volatility to do that expected value calculation, and I'm going to pick the same parameters that I did for the naked put. Click apply, and now I've got a positive expectation. I've got much lower risk and a nice positive expectation. Now one thing I like to do also is to sort the columns in the table, sort the table by the annualized expected return. If I click once, it sorts ascending. If I click again, it sorts descending. So there are a couple of other positions that I want to look at before I make my final decision on the trade that I want to put on. But I can see now that my put vertical is on the top here. There are a couple of things I still don't like about the put vertical. First of all, it's still got this. It raised my break-even point, and it's got this very steep downward slope on this profit curve going down to my max negative here. It didn't really do much for my delta. I still essentially long 53 deltas on the stock. It kind of took too much off the Vega. The Vega is now half of what it was before, and it really did a number on the time decay on the theta of the position. So even though the put vertical hedges your risk, it limits the ultimate downside risk, and reduces the margin. I would argue that that's not really a very effective hedge against downside move on the stock. One other thing that I always like to look at is a put ratio spread, and that's where you buy a put above the one that you sell. So if I'm selling 10 232.5s, I'm going to buy 5, let's say 230 235s or 237.5s to hedge that risk. And that turns out usually to be a better hedge, except that you don't have the limit on the downside. But let's see how that works out in this case, and we can fix that limit on the downside problem as well. So here I'm going to make this 5 lots, so I'm selling. I only have 5 naked on this, and I've got a 57-cent mid price on that. And then here's my put ratio. Let me go in and do the volatility adjustment so that we're looking at apples and apples. Okay. So now my put ratio, well, it's at the bottom of the list right now, and the put vertical is still at the top, even though it's still got a nice expected return. It's also got lower gamma, lower delta, so I have much fewer deltas on this. The vega is a little bit lower, and the time decay is about the same as the put vertical. But if you look at the profit chart, our put vertical has a downside break even here right now of about 232, let's call it. At 232 on the put vertical, I mean on the put ratio spread, I'm pretty happy with that. So if the stock goes down to where I would break even on the put vertical, I'm actually making way more money than my initial credit on the put vertical that I have on the put ratio. And the downside break even on the put ratio is down here at 229.5, let's say. On the put vertical at 229.5, well, I'm not very happy. I'm down like 2,500 bucks on that 10 lot. And on the naked put, just for comparison, at 229.5, well, it's a little better than the put vertical. I'm still not a happy camper, being down around $2,000. So right now, even though the put vertical and the naked put have slightly better expectation, the put ratio is giving me some better downside protection, I think. But I've also got more margin. That expected risk is a margin calculation, so I'm going to have to put up about twice as much margin as I would on the put vertical. So now also you can see the market's moving around a little bit. Now the put ratio has a slightly better expectation than the naked put, which is what I would normally expect. And actually, most of the time, the put ratio is going to have a better expectation than the put vertical as well. In this case, it doesn't. But if you still don't like the fact that you have this unlimited downside risk on the put vertical, you can actually you can do something about that and actually change this put ratio into a broken wing butterfly. And to do that, what you would do is you buy some puts underneath the one that you're short. So now I can hedge this risk. Basically, put a floor underneath what I'm risking by turning this into a broken wing butterfly. You see now the market has moved around a little. My put ratio is on top, which is kind of what I would have expected to begin with. But what I'll do is I'll click the copy spread button to make a copy of the put ratio. So now I have another put ratio down here. I'm going to click the detail icon, and so I can inspect the details and alter the position by buying the 220 put underneath it. So I'll scroll down here to 220, do that for August 29th. I want to do it at mid and want to buy 5 of them. I'll click add. Okay, so now I've got a floor underneath my put ratio. I got a 36-cent credit, and let's see what that does to the risk. So that lowers that risk quite a bit. I still have got that not negative expectation, so I'm going to go in here and change to 36, 3 years, and no earnings. Okay, so now my modified put ratio, which I turned into a broken wing butterfly, has a much better expectation than any of the other, especially the put vertical. It has the advantages of the put ratio, where if the stock moves down into that area where I'm selling, I get an increased profit. I have a much lower downside break even than the initial naked put or the put vertical, and I've also got a limited risk here. Now this one is only about a $5,000 risk, so I can actually do more of these, and I'm going to click in here and do 15 lots on that. So now I can take in $500 for risking. This is what the margin requirement would be, because we've got a vertical spread between 220 and 232 and a half on 15 lots, but my actual risk is slightly under 15 grand on this trade. If it goes down, that's the max that I can lose on this trade. So now what I want to do is I'll first let me change the name of this spread here, and what I'm doing is actually buying the Tesla 220, 232, 235 broken wing butterfly. So that's the position that I'm actually going to put on now. And I went to my broker screen. So I actually got 35-cent credit for this spread when I put it in a little bit earlier. I filled in my actual fill prices on the trade detail screen here. Actually, my price was 0.3499 on the fills that I got. So this is how I did the analysis and the discovery for this Tesla trade. If you want to see the execution piece, there's a video on execution. What I would do is click my shopping cart icon to submit the order, and then it would either go into my Option Workbench virtual account or into an actual broker account. In this case, I used the V account. But that's the discovery mini tutorial for August 19th, 2014. Thank you for watching.